Hey everybody, Andrew LaMacchia here with the Guild Mortgage. It's Monday, February 22nd. Hope everybody is back, ready to go. I know last week is a bit disruptive with the snowpocalypse happening, so I hope you and your family are doing well and everything's going to somewhat sense of normalcy. So I wanted to send a quick video out regarding interest rates. This is very important information. The video might be a little longer than usual, but I did want to bring you through some of the factors and what we can expect now and in the future regarding interest rates. So right now, the 10-year Treasury bond, which is where the mortgage interest rates are affected, at the highest level it's been in 11 months. So MBS, mortgage-backed securities, is really where our pricing is determined. This is demand for mortgage-backed securities. Lately, demand has gone lower since COVID hit, and therefore rates have remained low. But there's still some other factors regarding rates and where they're going to go in the future. The first one is when COVID hit, we got into a very steep but short recession. So inflation was low, demand to borrow money was low, investors got out of the stock market and into the bonds. So that was one large factor we saw that drove mortgage rates into the levels we saw last year. And the second big factor is that the Fed intervening and purchasing mortgage-backed securities on pretty much a weekly basis to make sure the housing market didn't tank or get way out of whack that caused even more disruption to the economy. So that was one factor, was the Fed buying a large amount of mortgage-backed securities, some months over 50%. And we feel they're going to continue to do this until full employment and hits, which is about 4.5%, and then also inflation is above 2%. So those are what kind of drove the low interest rates that we all enjoyed for the most part in 2020. Now, what's going on now? So first of all, the economy is starting to kick back up, right? The vaccinations are going up, new infections are going down, businesses are starting to reopen, jobs are starting to come back slowly but surely, consumer spending is going to go up, and therefore we're also going to see travel go back up, especially people who are already vaccinated. So that, combined with the largest stimulus package in the history of the economy, is going to reverse some of the trends that we saw in 2020, okay? Secondly, we do anticipate the Fed to stop buying mortgage-backed securities, okay? So that means that's eventually going to taper off, and it's really a question of when, not if. That's one thing we're trying to get as much information on as possible. So I wanted to bring a quick update because I think it's definitely important to start talking to your buyers. If you have buyers on the fence, if you have buyers who haven't locked, if you're talking with people who are looking to purchase 3, 6, 9 months down the line, that is some information I wanted everybody to be aware of. Right now, the rates are probably in the low threes, low to mid threes, which is still phenomenal if you think about it, but they're not at the 2.6s and 2.7s, and even lower that we saw at some points last year. So please reach out to me if you have questions, concerns, anything like that. There's a lot of stuff going on. I try to whittle it down to as little as possible, but those are some of the factors that we saw last year, combined with some signs that we're seeing going on right now, especially when the new vaccines, people getting vaccinated, jobs coming back, businesses starting to reopen, inflation is going to go back up. It's going to reverse some of what we saw back last year on the interest rate specifically. So please reach out. Let me know how I can help and be a resource. I love to help you and your clients as much as I can. I'm a phone call away. Andrew with Guild Mortgage. Thanks, guys. Bye.